Hawkish signals from the Federal Reserve, a sharp move in front-end yields, and an AI-driven tech rebound are pulling equity valuations in different directions today. You are watching vTalkInsight, Equity Pulse Daily for June 19, 2026. Let us unpack what this new policy regime, shifting oil prices, and powerful semiconductor leadership mean for equity risk and opportunity across regions and sectors. The dominant macro story is the Federal Reserve's clear pivot toward inflation control, with Chair Kevin Warsh ending forward guidance and putting data at the center of every meeting. Policymakers are openly worried about having missed their inflation target for roughly 5 years, and a growing bloc on the committee now leans toward at least one rate hike this year. That tone has pushed the 2-year Treasury yield above 4.2% on Fed Day, in its sharpest jump in about 15 months, and triggered a classic bear flattener as short rates rose while the long end held firm. The message from bonds is that the Fed's anti-inflation credentials are being rebuilt. Inflation expectations look anchored, but policy uncertainty is higher. Equities are wrestling with that mix. On the supportive side, investors see higher yields as a byproduct of resilient U.S. growth, strong labor markets, and solid consumer spending, rather than stagflation. Corporate earnings remain robust, helped by large fiscal deficits and sustained capex, especially around AI infrastructure, and recent sessions show the S&P dropping more than 1% on Fed Day before rebounding around 1% as volatility slipped back toward the mid-teens. The headwind is that a less predictable, more data-dependent Fed, with a weaker implicit safety net, likely demands higher equity risk premia and greater tolerance for drawdowns. Market pricing now bakes in roughly one additional hike by October, but not a long hiking cycle, so every inflation print and labor release can move the front end, and the multiple investors are willing to pay for earnings. Against that backdrop, quality of cash flows and balance sheet strength are becoming more central to equity narratives, and that sets the stage for the sector and thematic rotations we are seeing. Alongside the Fed, geopolitics and oil are reshaping the macro canvas for equities. An interim U.S.-Iran deal has reopened the Strait of Hormuz, tanker traffic is picking up, and Brent has slid toward the high 70s, with one print around $77 a barrel. Cheaper crude is easing headline inflation pressure and reducing the need for further tightening in regions like the Euro area, where lower oil prices are seen as a relief for growth-sensitive sectors and for the European Central Bank's reaction function. The flip side is equity. Energy names in Europe and the UK are underperforming as falling prices squeeze revenue expectations even as GCC exporters gain from volumes normalizing through Hormuz. In Asia, the same themes are playing out with regional nuance. South Korean tech stocks are lifting local indices despite broader softness, and Chinese markets are splitting, with AI-heavy mainland benchmarks near highs while large Hong Kong-listed platforms like Alibaba and Tencent lag on weak domestic demand. Europe sits between these forces. Lower oil prices help the DAX and industrial exporters, but hurt the energy-heavy FTSE, while softer commodity prices and disappointing retail earnings weigh on basic resources and consumer discretionary names. At the same time, a cautious Bank of England, a steady Swiss National Bank, and currency intervention risks in Japan underline that policy divergence is widening, which can feed further regional dispersion in equity performance. All of this means macro and policy geography matters more again for equity allocation than it did during the synchronous post-pandemic recovery. The most powerful equity theme cutting across this macro noise remains AI-driven capex, with semiconductors back at the center of market leadership. The Philadelphia Semiconductor Index has rebounded sharply, with all constituents recently in positive territory and the benchmark close to record highs after a double-digit drawdown. Chip leaders like Nvidia and Micron are again driving index gains as data center investment looks more structural than cyclical, and as earnings upgrades reinforce that view. Intel is a key micro-story here. Its shares have surged on confirmation of a U.S.-based chip manufacturing deal with Apple and on political backing from President Trump for a domestic design and manufacturing partnership. Apple's move to diversify away from TSMC into Intel and potentially Samsung, illustrates how AI demand, geopolitics, and supply chain resilience are intersecting. For U.S. equities, that supports the narrative of onshoring, capex, and earnings momentum, yet it also deepens concentration risk, with a significant slice of the S&P now trading at more than 10 times revenues and heavily exposed to AI optimism. There are early signs of broadening, with small caps in the Russell 2000 outperforming the so-called Magnificent Seven over the past 6 months, and rotation into equal-weighted indices and select foreign markets as more companies benefit from AI adoption. Still, market gains are heavily dependent on large U.S. technology and semiconductor names, while a coming wave of mega IPOs, including SpaceX and possibly Anthropic and OpenAI, could increase equity supply just as buybacks slow. That mix of structural growth and concentration is forcing equity investors to distinguish between durable AI cash flows and pockets that simply embed aggressive long-term expectations. At the micro level, recent company news underlines how strategy and positioning within these themes are driving sizable equity moves. Intel's rally on the Apple foundry deal and on speculation of further orders from firms like SpaceX showcases how being a credible U.S. manufacturing alternative can unlock demand as clients seek redundancy beyond TSMC. SpaceX itself is leaning into public markets with a planned bond sale of at least $20 billion and an investment-grade rating, while its role at the infrastructure layer of the AI stack and upcoming partnerships with Google Gemini and Anthropic are expected to more than double revenues over time. Elsewhere, Smith & Wesson has jumped on stronger than expected sales and bullish demand guidance through 2027, a reminder that niche U.S. consumer exposures can still deliver upside even as broader retail faces pressure. On the weaker side, Accenture has cut revenue guidance, reported a decline in bookings, and accelerated cybersecurity acquisitions as AI disrupts parts of its traditional consulting model, sending the stock lower in early trading. Supermarket names are also under strain. Kroger saw its shares fall despite sales support from price cuts as forward guidance disappointed, while Tesco and Carrefour are battling lackluster like-for-like sales and intense competition from discounters such as Aldi. In resources, gold miners are generating strong cash flow at current metal prices, but European precious metals names have underperformed on expectations of a more hawkish Fed and higher real yields. Energy equities are soft as oil slides, and European cyclicals such as parts of autos and basic resources remain under pressure, with Volkswagen's contested strategic overhaul and weak China performance emblematic of the challenge. Taken together, these signals point to a market that is rewarding clear earnings visibility, pricing power, and credible strategic pivots, while becoming less forgiving of business models that look vulnerable to AI, higher rates, or shifting consumer behavior. To pull this together, equities are navigating a new regime where a more hawkish, data-dependent Fed and higher front-end yields coexist with strong earnings, powerful AI-driven capex, and a meaningful disinflationary tailwind from lower oil prices. Leadership remains anchored in U.S. technology and semiconductors, reinforced by stories like Intel's partnership with Apple and renewed strength in Nvidia and Micron. Yet breadth is slowly improving as small caps and select international markets catch up. At the same time, valuations stretch, concentration in a narrow group of mega caps, a looming wave of AI-related equity issuance, and greater policy and geopolitical uncertainty all argue for a wider distribution of outcomes and more differentiation across sectors and single names. The key signals to watch from here are incoming inflation data, two-year yields, oil flows through Hormuz, and how AI capex and enterprise adoption translate into realized, not just promised, cash flows. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.